Thank you for joining us. I am your tour guide this afternoon. My name is Mike Madison. I am a law professor at the University of Pittsburgh and host of this ongoing scholarly seminar series on the future of technology, law, and governance. This is actually sponsored by, underwritten by, and the technology, importantly, supplied by the Center for Governance and Markets at the University of Pittsburgh. So full credit and gratitude to them. I am extraordinarily happy to welcome our guest speaker today, somebody I first met as an undergraduate at the University of Pittsburgh in the Honors College, I think more than a decade ago, and have followed their career through graduate school and now to a faculty appointment at the University of Maryland, excuse me, in the College of Information Studies. And this is the culmination of a long anticipated conversation about having Mols come back and give a talk, not physically at Pittsburgh. Unfortunately, we'll see if we can arrange that going forward, but today we'll do the next best thing, which is to have the talk be virtual. And with that, I am going to turn it over to Dr. Mols Sauter to present and explain the work. The talk will be for give or take 25 minutes, and at roughly half past the hour, we'll turn it into a Q&A, which I will moderate for the 30 minutes to follow. So thanks, and take it away.
Great, thank you so much. Okay, let's share this thing. Can everyone see this slide? Awesome, great. Hi, thank you so much, Michael, for having me. I'm super excited to get to present this work at this seminar. The theme of this seminar is, in theory, the future of law, which is super exciting, super important. This talk is not about the law's future. This talk is actually about the law's past. Specifically, it's about the history of venture capital investment, how and why it developed the way it did, and the policies and regulations that allowed it to flourish in sort of the form that we know today. It's part of a much larger project examining how venture capital became an intrinsic part of what we would in the 1970s call the high technology sector and what we might now call the innovation economy. It's sort of my hope that by examining this particular funding strategy and how it became embedded in the US tech sector, that we can then sort of think about what that means for how technology developed, what it means for how we think about technology and what technology can, should, and can't do as we sort of go forward. So just as a warning, some of this talk is probably going to be incredibly boring, but that's how the neoliberals get you, by being very boring and letting the things that they're doing sort of pass under everyone's radar, because who cares about tiny little word choices? Turns out you should. So by the early 1970s, venture capital sort of existed. It was gaining name recognition as this distinct category of investors, separate from other types of investors, but the profession itself was very haphazard and very struggling. Its practices, strategies, and organizational structures tended to vary widely from firm to firm, the few firms that there were, and investment to investment, even within a single firm. There also weren't that many of them. The National Venture Capital Association, which was the industry's first professional organization, had 17 member firms when it was first chartered in 1976. Their only real commonality was that they were all interested in making equity investments in early stage firms. They couldn't even really agree on a name for this practice, and you'll find the terms venture capital, equity capital, and risk capital used almost interchangeably up until the 1990s. These early venture capitalists were dogged by regulations that nipped away at what they saw as their most profitable activities and everyday operations. Multiple SEC regulations intended to curb insider trading and aggressive or fraudulent sales tactics had made it difficult for venture capitalists by the early 1970s to make equity investments without the cost or hassle of registering those securities, and made it nearly impossible for those unregistered securities to be then sold on the secondary market. Many practicing venture capitalists felt their ways of doing business and their most ways of making a profit were unfairly and in some cases fatally hamstrung by regulations intended to curb the historical abuses of other investors, you know, those other guys. The cartoon shown here, which was published in the winter of 1974 and syndicated in daily papers across North America, indicates the extent to which venture capital as a collection of investment practices was sort of broadly considered to be a flash in the pan by the mid-1970s, an interesting but ultimately unsuccessful blip on the financial and business landscape. Reed Dennis, an early venture capitalist who was backed by American Express in the 1970s and who will come up again later, recalled seeing this cartoon pinned to the back of a Treasury Department undersecretary's door in 1977. So how did venture capital go from being an object of ridicule in the daily paper that a regulator was making fun of with his office decor to this? To a revered and highly sought after mode of funding, inextricably linked with innovative technology, massive economic growth, and equally massive investor returns and dividends. In just a decade, because there is just a decade between this cartoon and Arthur Rock appearing on the front cover of Time, we completely change how we think about this investment practice. A few booms, bubbles, and busts later, venture capitalists now make frequent appearances not only on the covers of technology and business publications like Wired and Fortune and Forbes, but are a frequent source of guidance and prognostication on technology, society, and the future by news publications and even policymakers. So how do we get here? So I've made us a helpful timeline that we're going to refer to as we go through this talk, because the things I'm talking about occurred in history, which is helpful. So they occurred from a point A to a point B to a point C, but they're also fairly recursive, and you kind of have to understand a lot of concepts inside of what I'm talking about. So we're going to start with this timeline. So 1940s to the early 1970s, you have what is essentially a small group of venture capital firms beginning to explore something called the institutionally supported limited partnership firm structure, which I'm going to smush into ISLP. So I don't have to say all of that all the time. They especially are interested in using pension funds and insurance companies as limited partners. And we'll get to what that means in 2 seconds. Right now, we're just going to get the timeline down. 1974. The Employee Retirement Income Security Act, otherwise known as ERISA, passes. The aim of this act is to address corruption, mismanagement, and fraud in pension management, both private pensions and public pensions. The act includes fiduciary liability or trustee liability and a new federal prudence standard specifically tailored for the management of pensions. I will explain all of that in 2 seconds, but all you need to know is that 1974, we get ERISA. 1974 to 1979, venture capitalists and others advocate for reforms to ERISA, claiming that it is the cause of an equity crisis for small business. Specifically, critics call for an explicit inclusion of something called modern portfolio theory into ERISA's prudence standard. Again, we'll get to that in a second. 1979, the Department of Labor issues a clarification of the ERISA prudence standard that functionally adopts modern portfolio theory, thus opening up 10% of pension fund assets to high risk and speculative investments that had previously been off limits. So that's the timeline. That's the tick-tock of how sort of we're going to walk through this. This is what happens after 1979. So scrabble back 1 year, 1978. Here's the state of venture capital in 1978, before the ERISA clarification. The total amount of capital invested in new ventures is about $216 million. And most of these figures are taken from an article by Paul Gompers called The Rise and Fall of Venture Capital. Paul likes venture capital a lot more than I do. So we're going to trust his numbers on this one. In that $216 million, pension fund investment makes up about 15%, or $32.4 million. Individual investment is the largest share of that funds. That's rich people investing in things. It's about $69 million, or approximately 32%. The total of that capital pool that is managed by institutionally supported limited partner firms is 35%. So we got a third is managed by these limited partnership structure firms. About 15% is pension investment. Most of it, 32%, is individual investors, rich people supporting small firms. 9 years after the ERISA clarification in 1988, the total amount of capital invested in new ventures is $3 billion. The pension fund involvement is $1.38 billion, or 46%. That is a over 4,000% increase for those of you following along at home, which is everyone. The individual investor involvement has increased in terms of raw numbers, but in terms of the share of participation has tumbled to 8%. And the total percentage of that capital pool that is managed by limited partnership firms is now 75%. So in the course of a decade, we have not only a huge increase in the overall amount of money invested in early stage firms overall, but a huge explosion in pension fund involvement and a huge explosion in these limited partnership firms. Now I'm going to break down what all of that means. So I've given you the story, I've told you the ending, but let's break down what all of that means. What is a ISLP firm structure? How do they rise and what is its logic? So an ISLP, or an institutionally supported limited partnership firm, is what you probably think of as a venture capital firm now. They make lots of investments in the hopes of that a few will pay out and cover a lot of those expected losses. It has two types of players. The first is the general partners. These are the people whose names are on the door and whose pictures show up on the cover of magazines. They're the people who you think of as venture capitalists. They manage the funds, they make the choices. Then there are limited partners. Limited partners provide the capital. These are typically major institutions that can park capital for a very long time. They don't need to be making very small trades. They don't need to be doing a lot of micromanaging. They can take money and park it somewhere and not think about it for a couple of years. These are things like endowments, university endowments, insurance companies who have a lot of insurance premiums that they need to invest, or pension funds, which are a lot of money that people have been putting away in the hopes that they might someday retire. These funds are typically time limited, which is why it's important that these limited partners can just park it. They're just like, take this bajillion dollars and hold on to it for a while so I don't have to worry about it. General partners in a limited partnership firm are paid both a management fee, so they get paid what is essentially a salary, and a share of the capital gains at the end of the life of the fund. This is usually in the range of 20%, with limited partners taking the rest of the capital gains. This is clearly a very lucrative firm structure for the general partners. Up until before ERISA showed up, there were a very small number of venture capital firms who were interested in the ISLP firm structure. There were about 4 major firms. The first is ARD. ARD is typically considered to be the granddaddy of venture capital firms. It's founded by George Dorio in 1947 with a combination of institutional, government, and individual investment. It's later converted into a publicly traded corporation and merges with Textron in 1972 because George Dorio decides that the Investment Act of 1940 puts too many restrictions on what he can do. So he folds the firm entirely because he's hampered by regulation. DGA is founded in 1959. It is generally considered to be unsuccessful due to the early illness of a general partner, and it was ultimately liquidated in 1967 after many of its limited partners ended up leaving. Heiser Corporation, which was founded in 1969, is considered to be the first mega fund. It had $81 million under management, and it had significant public pension involvement. Interestingly enough, the Chicago offices of the Heiser Corporation served as the first official headquarters of the National Venture Capital Association when it was founded in 1976. And you're right, this fact will come up later. And last, we have Newcourt Private Equity. Newcourt Private Equity is founded in 1972. It is a subsidiary of the Rothschilds American Family Office, and it starts as an experimental limited partnership interested in early stage investment and includes as its limited partners the private pension funds of IBM, AT&T, and RCA. So we have a few firms that are interested in the limited partner structure. 2 of them sort of dissolve or are sort of like fade into the mist. Davis and Rock is very successful. I think I skipped Davis and Rock in this timeline, but Davis and Rock, which was founded in 1961, you may remember that Arthur Rock is the guy on the cover of Time a couple of slides ago. It's a very successful firm. However, it willingly dissolves in 1970. Arthur Rock decides he has made enough money in this fund, and they fully dissolve the firm in 1970. So we have what are essentially two funds that are by the early 1970s closed, then a third, which closes successfully. And then you have Heiser and Newcourt, and they're the big players in the ISLP space when 1974 rolls around. 1974 shows up, ERISA comes in and it bans high-risk investment or speculative investment with pension monies through its prudent standard and makes pension trustees liable for losses from mismanagement, thus fencing off a huge portion of capital from these last two firms, which are the ones active in this space. What is ERISA? Why do I keep saying it like it means something to anybody? ERISA is the Employee Retirement Income Security Act, again, passed in 1974 after a 12-year gestation. It is a long in the making piece of legislation. ERISA was deemed to be necessary due to a recent history of pension fund collapse due to either mismanagement, fraud, or being rendered useless by a company setting unreasonable qualification criteria. It's very complicated, and we're going to focus on two provisions out of all the things that ERISA does. We're going to focus on its fiduciary or trustee liability and the prudent man standard that it sets up. So, what was the situation prior to ERISA? Why was ERISA necessary? So I have here a quote from Senator Lloyd Bentsen, who was ERISA's major sponsor. He is a Texas senator. And he said this in 1973. He basically says in this quote, we have at the time a robust retirement system for Americans. Many people retire successfully with their pensions, and that's great for them. In the bolded portion, he says, but unfortunately, there are instances where workers have not received pension benefits that they have earned through years of long, hard labor. Their dreams of financial security after retirement have been shattered. Promises have been broken. In these instances, America's private retirement system has not only failed to perform adequately, but it has performed very poorly. At this time, pensions were typically regulated under state law. They were regulated by the state of the company, like that the company they came from was based in. Things called exculpatory clauses were permitted, which meant that trustees or fiduciaries could contractually opt out of liability for damages. They could write a little clause in their contract that said, if I lose all the pensions betting on a bad stock, you can't get me because I said you can't. There were no consistent disclosure requirements and no consistent or federally enforceable prudence standard. ERISA itself is an attempt to solve that. So here's a quote from Ian Lanoff, who was the Department of Labor Administrator of Pension and Welfare Benefits Programs at the time ERISA was passed. We'll be hearing quite a bit from Ian over the course of this talk. ERISA did not create the promises to pay benefits that companies and private pension plans have made to workers participating in so-called defined benefit plans. It simply ensures that those promises are kept. So that's what ERISA was trying to do. Essentially, ERISA says pensions are the deferred wages of workers that they are contractually owed. As Lanoff also says in this article, it is grossly unfair to ask workers to forego wage increases when they have no assurance that a benefit will be there when they retire, which, fair point. Exculpatory clauses for trustees are banned as inconsistent with existing law. It is allowed that the losses of pension funds due to imprudence can be recovered personally from the trustee. So if the trustee blows all of your pension funds betting on something he shouldn't have, you can sue him directly and possibly try to get that money back. And it also creates, again, a prudent standard for pension funds enforceable by the Department of Labor. Now, I have been saying prudence a lot and not defining it. What is a prudent standard? Who is this prudent man? Has anyone ever met him? So glad you asked. So the prudence standard is a standard that exists for the management of trusts. It comes out of the 1830s from a decision called Harvard v. Amory, which I'm not going to get into right now. But what you need to know is basically when you're managing a trust, that is, you're managing money on behalf of someone else, someone who can't manage their own money, you are held to a standard. That standard is how men of prudence, discretion, and intelligence manage their own affairs, not in regard to speculation, but in regard to the permanent disposition of their funds. So that is what's articulated in the Amory decision. Now, in 1959, we get what is called the Restatement Second of Trusts. There are a number of these. We care about the second one right now because this is what was in force when ERISA shows up. The Restatement Second of Trusts defines the duties of a trustee or a fiduciary in part as in the absence of provision of the terms of the trust or a statute otherwise providing, to make investments and only such investments as a prudent man would make of his own property, having in view the preservation of the estate and the amount and regularity of the income to be derived. Specifically, it marks out the following as imprudent per se. These investments are imprudent and you shouldn't make them with trust money. Speculative investments made with the goal of increasing rather than preserving the principal, and investments in new and untried enterprises. In fact, the restatement second gives this example as a bad investment. A bequeaths $100,000 to B in trust. B uses $10,000 in purchasing the bonds of a newly formed corporation organized for the manufacture of a new kind of airplane. This is not a proper investment for trusts. Don't do that. That is imprudent per se. Now, ERISA's prudence standard defines prudence as acting with the care, skill, prudence, and diligence under the circumstances then prevailing that a prudent man acting in a like capacity and familiar with such matters would use in the context of an enterprise of like character and with like aims. Now, I invite you to notice the fiddly shift that has occurred in our language from a man managing his own property to a man managing an enterprise of like character. Is this going to become necessary when it becomes a key point in arguments of bad faith made by other people who wish to get their hands on pension money? Maybe. This was deemed necessary because framers were concerned that common law prudence standards was not sufficiently flexible to manage pensions. Pensions are really complicated. They're very different than traditional trust vehicles. So they thought, hey, why don't we give this, in theory, trustee some leeway in how we determine what is prudent in these situations? However, this prudence standard is still intended to prohibit speculative investments in new business. How do we know this? Well, Senator Lloyd Bentsen, one of the major framers of ERISA, says in a newspaper interview in 1977, no one is going to bring a liability suit against a pension manager because the stock of General Motors or IBM went down the tube, but they might have if he invested in Widget Corp. So we see that the framers intend to exclude speculative investments in untried enterprises with this prudence standard. ERISA is unpopular when it is passed. It is unpopular amongst many different people for many different reasons, but possibly because it's effective at doing the job it was designed to do. ERISA was unpopular because it's super complex, and you'll notice this funny joke from Professor Howard R. Williams in 1975. Conceivably, an honesty and labeling policy would require that ERISA be entitled the Lawyers Relief Act of 1974. And it's also unpopular because of its impacts. Again, we're going to visit with Ian Lainoff again. ERISA's critics are correct in saying that the law shifted the burden of risk from the workers to the companies. That is precisely what ERISA intended and is the way it should be. So the goal of ERISA is to keep workers' pensions safe, is to keep them from being speculated with and sort of made into a tool of financial capitalism. And that's what it is effective at doing. Then, prudent man, meet prudent expert, and watch my hands for this one. Critics argued that ERISA's prudent man was actually a prudent expert, operating not as an intelligent private citizen, but as a financial professional operating in a community with other financial professionals. You remember we went from having a man in charge of his own affairs to a man operating in the same way as others would, working with a like enterprise. So we go from perhaps a paternalistic father figure who's managing the trust for someone who cannot handle it on their own, to a prudent expert operating in a professional community. The prudent expert, they argued, possessed special professional knowledge and was able to avail himself of sophisticated strategies, theories, and practices that were beyond the knowledge and abilities of the average prudent man. In assuming a professional community, critics argued, the prudent expert standard created a standard of prudence based on conduct in accordance with a community rather than results, as in the strict liability ERISA had introduced would otherwise imply. Prudent expert, meet modern portfolio theory. Ta-da, the aristocrats. Robert Posen writes in 1977, in part, by establishing the prudent expert standard, ERISA opened the door to modern investment practices. For example, because most investment experts for large financial institutions view their investment decisions in terms of the whole portfolio, ERISA should allow pension managers to adopt that viewpoint. Now, what is modern portfolio theory? Well, it comes from the Chicago School, creepy voice. Modern portfolio theory is developed by Harry Markowitz in the 1950s. It argues that the value and risk of a single investment can only be judged in the context of a full investment portfolio. Risk here is a neutral aspect of a given investment, indicating both losses and potential for profit. The risks of an investment or its alpha should be balanced in a portfolio with the risks of other investments and the risk of the market environment as a whole, which is referred to as beta. For example, if you want to get shares in an experimental technology enterprise that has a high risk of failure, let's call it Widget Corp for the sake of consistency, that would be balanced by holding a more conservative investment like US Treasury bonds. The goal of this is to create an efficient portfolio which properly balances investment risk and environmental risk to achieve the highest possible profits in a given market environment. You may notice that modern portfolio theory's understanding of risk is utterly antithetical to the understanding of risk present in the dominant understandings of prudence at this time. Other people also noticed that. In fact, the idea that the prudent expert standard inherently incorporates modern portfolio theory was very, very controversial. Many commentators considered modern portfolio theory to be fundamentally irreconcilable with the prudent man or prudent person rule. And people were mad that any amount of pension monies might be open to risky investment, either through an introduction of modern portfolio theory or through something called a basket clause. In fact, Arthur L. Fox, who was an attorney for the Teamsters, testified at a proposed ERISA amendment hearing in 1977. We simply don't believe that managers of pension funds ought to be able to treat even a small percentage of their funds as mad money. The debate on modern portfolio theory inclusions into pensions and trusts went on for a very long time. In fact, this is a quote from a 1993 Law Review article, of which I'm only going to read to you the title because I think it says it all. Trustee investment, the prudent person rule, or modern portfolio theory, you make the choice. And if you wish to come back and read this quote, you can at a later time. And then just like that, 1979 rolls around. The Department of Labor issues a clarification to ERISA's prudent man rule. This clarification reads, the department is of the opinion that generally the relative riskiness of a specific investment or investment course of action does not render such an investment or investment course of action either per se prudent or per se imprudent, and the prudence of an investment decision should not be judged without regard to the role that the proposed investment plays in the overall plan of the portfolio. Now, this sounds a lot like modern portfolio theory and not a lot like the prudent person or prudent expert rule that we had previously been discussing. This clarification also explicitly stated, just in case you missed it, that up to 10% of a pension fund's assets could be invested in high-risk investment funds like venture capital funds without being classified as imprudent. The impacts on venture capital were functionally instantaneous. Here we have a quote from Senator Gaylord Nelson in 1979, who says that together these items, by which he means the 1978 reduction in capital gains tax and the ERISA prudent man clarification, have resulted in the flow of more than $1.5 billion into the new venture capital to the small business community since the end of 1978. As a result, the venture capital industry has been able to survive. According to testimony by the National Venture Capital Association before the committee, the infusion of new capital has added almost 50% to the amount of funds which were available to finance new and small business. So this is the same year. This is basically, we get ERISA clarification, venture capital rises from the slab. Just to say, the point about the capital gains tax here, the capital gains tax change was not as impactful as Nelson would like it to have been, as pension funds and other institutional investors are usually not for profits and did not pay capital gains tax. However, who did pay capital gains tax would be the general partners of venture capital firms, but we're just going to leave that on that slide. But we're not done. Fast forward a few years and we get the 1990 restatement, third of trusts. Now see if you can spot the change. The trustee is under a duty to the beneficiaries to invest and manage the funds of the trust as a prudent investor would. I love that change. In light of the purposes, terms, distribution requirements, and other circumstances of the trust. The standard requires the exercise of reasonable care, skill, caution, and is to be applied to investments not in isolation, but in the context of the trust portfolio and as a part of the overall investment strategy, which should incorporate risk and return objectives reasonably suited to the trust. So now we have a change in trust law itself. We have gone from having a prudent man standard to having a prudent expert standard. Now we have a prudent investor standard, which is just kind of hilarious, but it no longer says that a prudent man does not make speculative investments. A prudent man does not overly invest in untried enterprises. In fact, it says that investments such as real estate and venture capital and techniques such as borrowing are not per se prohibited. We have fundamentally, over the course of less than 30 years, changed how we deal with the expectations of trusts. We have thus redefined fiduciary protection within the trust vehicle and the pension fund as inherently accepting and even requiring substantial risk-taking. And this is a quote from scholar Sabine Montaigne, who's written a great deal about this and who is amazing. Fiduciary capitalism does not mark the advent of a new compromise between wage earners and capital, but rather a renewed form of the seizure of fiduciary power by institutional investors and a new stage in the history of the expansion of finance. ERISA reform, I argue in my work, represents a risk shift, whereby the deferred wages of workers, which have been intended to be highly protected through pension funds' use of the trust structure, were intentionally stripped of that protection so they could be used as capital stakes for high-risk investments by an emerging class of professional financiers called venture capitalists. ERISA reform moves the risk from financiers to pension beneficiaries while gutting the protections that ERISA originally created. But wait, how do we know that? You're supposed to be a historian. Is there history here? Well, bless their hearts, they actually just come out and say it to people when you ask them. Early venture capitalists knew that the prudent man rule and venture capital were incompatible. Here's a quote again from Reed Dennis, who I said would come back. He says, well, the prudent man rule on one side and venture capital on the other are really two diametrically opposed propositions. To invest in a company that doesn't exist in the present time and bet on managers who you can't see them actually doing their management job in that environment. Charles Lee, who was a general partner in Newcourt Capital, which, as we recall, was one of two active limited partner firms at the time that ERISA was passed, played a significant role in the lobbying effort that led to the Department of Labor's clarification. Here is a quote from Lionel Pincus, who was a general partner in Warburg and Pincus at the time. On behalf of the NVCA, Charles Lee and I led the negotiation with the Labor Department of the pension plan asset rules in 1978 and 1979 that produced the Prudent Man regulations and the contemporary venture operating company. These regulations made it possible for pension funds to invest directly in venture capital funds and opened a floodgate of new capital to our young industry. So how did we go from remember venture capital to the man who makes the future? Policy tweaks that seem minor and dull and avoid democratic oversight by being tweaks, but are really quite severe and have a lot of impact. Thanks. Any questions?
Awesome. So virtual applause. Q&A. I see Lee in the chat had a question in the chat. Is it okay, Lee, if we go to you to lead us off, and then anyone else who wants to ask a question, just use the raise hand function in Zoom.
Yeah, for sure. It was just a super small clarification around that bit around that it enabled venture capital to survive. I'd be curious if I don't know if I missed something or if there's like some context to like, did people think it wasn't going to survive because it sucked or for some other context reason?
It was very disorganized, and people were sort of like, why would we do this when we can either have bank loans? There were things running around called SBICs at the time, which are actually still around. They're small business administration backed, government backed loan outlets. Essentially, what needed ERISA to survive is specifically institutionally supported limited partner firm structure venture capital. that relies
Pensions
on
as
making,
LPs, basically.
sorry?
Pensions as LPs.
Pensions as LPs, basically. But if ERISA had stood, the limited partnership firm structure and venture capital as we know it would have, like, I'm willing to say, would have collapsed, or certainly was on the verge of collapsing. What is also interesting, and which makes up the bulk of my 400-page dissertation, of which this is one 50-page chapter, is that was the image the venture capital industry was trying to build and sell. Because the other thing that was happening at this time was there were a group of people, of whom Charles Lee was one, who were engaged in creating a narrative of what a venture capitalist was. And for them, the venture capitalist was this person who engaged in this type of institutional money laundering, like investment for early stage small companies. And that was not an accepted truth, that was what a venture capitalist was. No one knew what a venture capitalist was at this time. It was actively being invented. And so that's the other thing, is that this fit with a narrative that was being presented.
Elizabeth.
So my question is, you've talked about pensions, but you also flagged that there are other sources of investment, and you mentioned university endowments. So I was wondering if you could speak to the history of how university endowments have been managed, and did that get involved with this trend?
I cannot speak about university endowments in particular. I haven't spent a lot of time poking around in there. If you are interested in the history of university endowments, specifically in venture capital, I would look at the history of the MIT Corporation and ARD.
I have a question, but I want to make sure everyone else who wants to raise something. Okay, so here's my question. First of all, this is super fascinating. When my prior life as a practicing lawyer, I was in Palo Alto and I represented venture capitalists. And when you said Reed Dennis, his firm, Institutional Venture Partners, was actually my client at one point. And the general partner of Sutter Hill Ventures, interviewed me when I was a high school senior on the way to college.
I have a quote from him in here too.
So the actual question is, so your whole research program and your presentation leans very, very heavily into system and structure. You mentioned Reed Dennis, who is sort of this foundational figure. You mentioned Heiser, who's also Edgar Heiser, who's also a foundational figure. But you don't talk in much detail about the agency side of the equation. That's personal networks and contingency. And Heiser and a lot of the early work was done in Chicago, and then Bill Draper, who was in Chicago, moves to California and literally invents West Coast venture capital, eventually founding Sutter Hill, et cetera. And so I'm wondering about your perspective on that interplay, kind of a standard interplay between structure and agency. And let me add one more anecdotal piece to this that kind of ties it to your argument about ERISA. When I was a practicing lawyer in Palo Alto, I was at a big corporate law firm, and one of the senior partners of that firm was one of the senior kind of deans of the corporate finance bar in Palo Alto, so representing all venture capitalists, et cetera, et cetera. His wife, also a senior lawyer in the firm, her practice focused on ERISA. So you literally had in one senior power lawyer couple, and in Silicon Valley, as you probably know, the lawyers make all the trains run on time and connect all these deals. And they both started their careers in Silicon Valley very much around the time that ERISA was enacted. And ERISA was passed in 1974. And Greg and Penny Gallo both came out of Harvard Law School in the late 1960s. So they were sort of there at the formation. And as you said, this was a very small community. And people were figuring out how to create the identity of a venture capitalist. They were trying to figure out how to take advantage of modern portfolio theory. So I wondered if you could talk a little bit about your view of the role of agency in the context of this structural story that you're telling.
Yeah, so the whole dissertation project is actually my effort to say, so we know one story about venture capital. There's one, Annalise Saxenian is the canonical scholar who's telling the story of what we think of as the history of venture capital, which is that it's West Coast, it's a lot of people sort of exchanging money together. It's a lot of people coming out of like the Traders 8 and the Fairchild firms, and they're giving each other money, and venture capitalists sort of come out of engineering. They come out of technology. There's something about technology and about West Coast engineering that makes venture capital an appropriate and preferable funding strategy. And what I have spent 400 pages exhaustively arguing is that actually the people on the West Coast at this time didn't care about policy. They didn't care about regulation. They thought people who cared about policy and regulation were kind of weird nerds who lived on the East Coast. And I'm not just saying that because I'm mean, I'm saying that because I have quotes from people at Sauter Hill Ventures saying, we thought people who cared about policy were weird nerds and we didn't like hanging out with them. What I'm arguing is that there was a group of people on the East Coast who were primarily old school financiers. So Charles Lee works for the Rothschilds. You can't get more old school finance than that. But the main character of my dissertation is actually, who did not appear in this presentation at all, it's actually William J. Casey, who you may know from the time he was the head of the CIA and ended up causing the Iran-Contra affair, or certainly sort of brought that to light. But before that, he was a very, very successful tax attorney. He was the head of the SEC. He was the head of the Export-Import Bank. He was a major player in finance bureaucracy. And these guys, these East Coast financiers, were the people who cared about policy. They were the people who cared about laws. And they actually, the thing that the project is mostly about is about a small business administration task force that they are on that is putting forward this legislative agenda. So Charles Lee is on that task force. He is pushing the legislative agenda that this task force is coming up with. They're the people who are giving a lot of speeches and interviews and writing op-eds about this new thing called the venture capitalist. It's going to be great. It's super tied to American history. It's super tied to Manifest Destiny. It's super tied to American colonialism abroad. It's about, like, it is the story of America, the venture capitalist. And so when I talk about like this is a lot to do with community and how people view themselves as communities. And what I'm arguing is that, opposed to histories that we previously have known about how tech developed, how venture capital became involved in it, there's this other group of people on the East Coast, in DC and in Washington and in New York and Chicago, who are the people making it possible for what we know as venture capital to move forward. If it had been sort of left in the West Coast, ERISA would have passed. It might have fallen down, like we might have still gotten the basket clause. We might have still gotten some other things that made ERISA non-functional. But the venture capitalists in the West Coast were not concerned about it. They didn't really want to touch pensions at this point in history.
I was going to ask about the chicken and egg between the sort of conceptual narrative around, I don't know, like if you just imagine the canned extract of the Institute for the Future, but that kind of, that kind of narrative around we're building the future, why would you want to live anywhere else? And the VC financial structure, and kind of where did that chicken and egg come out? But I think you partially just answered that question.
Yeah, so I would, in order to answer that question more fully, I would want to like take Fred Turner's work and my work and spend more time drawing the lines between like who's where when. Though there is a really exciting, and by exciting I mean horrible, sleight of hand that happens in the writings of this task force, where they're trying to make a point. Casey specifically is trying to sell this idea that they should just be allowed to trade unregistered securities willy-nilly, and no one should have to disclose anything when they sell unregistered securities on the secondary market, because that makes it easier for them to sell. And in making that argument, he makes an argument that basically says a venture capitalist is better at thinking about the future and is better at taking risks than your average person. And therefore, we should not be constrained by these protections, these SEC protections that are put in place to protect your average Joe, your average, what we would now call a retail investor, because we're special. We're too special for laws, and we are special in the way that we know how the future is going to go, and we have a special connection to the future. I don't have the chapter printed out in front of me, so I can't read you the quote that is literally we have a special connection to the future, but it is just we have a special connection to the future, and therefore you shouldn't regulate us. So this idea that we're building the future does end up very strongly connected to this mythos of the venture capitalist. Which he also ends up trying to connect to literally to Manifest Destiny, literally to Queen Elizabeth's armadas of boats. He talks about Queen Elizabeth in one of these things. It's wild, the undiluted ideology in these documents. Bye, Brett. Thank you for coming.
Additional questions? So, I mean, I'll just keep going if that's okay. So you led off by saying, this workshop series that I've organized is about the future of law, and your talk and your project is about the history and how we got here. But I wondered if you were willing to speculate a little bit about, say, the relationship between what you just talked about, this sort of messianic, sort of semi-divine ideology that accompanied the creation of this sector, and how it is playing out today in terms of modern tech development, the kind of deference that big tech companies are sort of presumably expecting from regulators and society at large, and all the wonderful things that are happening as a result of that.
Yeah, so I had a slide on here for a little bit. I ended up taking it out during a revision, where it's basically this presages, this prefigures a lot of the entitlements about data that we see now, where it's there's this big bucket of money. It's supposed to be protected because it's supposed to end up being used to take care of people in their old age. But right now it's just a big bucket of money, and I kind of want it. And if we look at sort of conceptions of data, it's there's a big bucket of data here. It's supposed to be private and it's supposed to be protected, but I kind of want it. I want to do stuff with it. I should just be allowed to do stuff with it. I should be able to set up a camera, as I just wrote a piece about smart city surveillance regimes. I should be able to set up a camera and film people literally anywhere, because I want that data, because I want to do stuff with it. And so there's a very grabby hands sort of ethos there. And what we also see is sort of so that there's that. There's also the sort of entitlement to conceive of the future. There's all this other stuff. So recently, and by recently I mean in 2012, there was something called the Jobs Act passed. And part of the Jobs Act was an attempt to open up early stage investment to retail investors, because everyone was venture capitalists make so much money, but retail investors don't make a lot of money. Maybe what we should do is make it easier for retail investors to invest in early stage untried enterprises, and then they'll have a lot of money, which is not how any of this works. It's not how it works. That's not how any of this works. And so that's been a thing that's been going forward very slowly since 2012, because honestly, the SEC has been slow walking that set of regulations, because they know in their hearts that it will be bad for everyone. And so that's something that I'm really interested in, is this idea that venture capitalists are inherent to technology. They are inherent to the innovation economy. If we want more people involved in the innovation economy, we have to open up the riskiest type of investment to essentially orthodontists who are going to lose their shirts. And then, so there's that. And then there's this other, and I know I'm sort of jumping between a lot of different things right now, but the other thing I care about is the way in which venture capital is viewed as so intrinsic to an innovation economy that anytime a non-bicoastal US city decides it wants an innovation economy, the first thing it does is say, how do we get venture capitalists interested in us? And this is so intense that Canadian cities, because I care a lot about Canadian cities and Canadian innovation economy projects, that's a major thing that they're very interested in, is attracting specifically American-based venture capital firms to their innovation alleys. And Canadian pension funds are very involved in venture investment, specifically Ontario teachers and major public pensions from Quebec. And that is a fascinating exercise in corporate colonialism and extractive capitalism, which I don't need to get into right now.
But it's fun to get into it. Well, and partly, let me just push back a tiny bit on part of that story, because I mean, Pittsburgh, where some of us are, is a perfect emblem of this, right? So I participate in communities around Pittsburgh that sort of, you know, if we had more venture money to the tech sector, which is supposedly the anchor of the forward-looking economy here, would be better financed, faster paced, and if you do it right, it actually ends up being equitable, which of course is really, really hard. But it becomes something of a self-fulfilling prophecy, which is to say, the community says, well, we can't get better until we get venture money. I know plenty of venture capitalists. There aren't that many of them in Pittsburgh, but I know plenty of them in California. And they say, why should we bother with a place like Pittsburgh? There's plenty to amuse us in Palo Alto. And I've talked to people in places like Hamilton in Ontario, which is kind of the Pittsburgh of Ontario. And they have the sort of a version of exactly the same problem. So I guess the challenge is how to break out to this, when it really becomes a self-fulfilling cycle.
I mean, the challenge is to realize that there are other types of money and funding than venture funding. Like, an exciting thing, like one of the things that I was like excited to find, I use exciting in an archivist's way. One of the pieces of paper I was excited to find in this archive that I got really involved with at Stanford was, there is a letter in this task force archive where one of the task force people, I'm pretty sure it's Heiser, says, so most of the people who are starting small businesses now don't want to have equity investment, because equity investment feels to them like they're losing part of their business. And they would much rather take debt investment to expand their business. We really should figure out a way to get them to stop thinking that, because we can't invest in equity if they won't sell us equity. And so there's this thing where I'm looking at the history where it's like, business didn't want this. People who were making their own businesses, they were surveyed. They did, like, the people these guys were talking to didn't want it. They didn't want what they were selling. And yet these financiers were like, well, this is more like, it's really just very clear where it's like, well, this is better for us. So we need to find a way to dissuade you of your own preferences. And it's kind of funny and kind of very upsetting.
But it's also, history repeats itself, right? So you've got the same thing happening in the savings and loan crisis, or what led up to the savings and loan crisis in the mid 1980s, the same thing that leads up to the meltdown in 2008. You've got a financial sector that decides it knows what's best for everybody, which is essentially enormous margins for themselves. And they're on a mission to persuade everybody to join them in the casino. Yeah. And we all know. Why
should I look at the horrible things that are happening now when I can look at the horrible things that happened 50 years ago and they're basically the same?
Well, but of course they're able to push off the losses onto somebody else. And so it's not really their problem. They can either, in the SNL case, and then to some extent in the 2008 situation, you end up with either insurance or bailouts that come in and solve everybody's problem, because you know what the world looks like in the wreckage of the casino economy is just too grim to imagine.
Yeah. And of course, the thing that always gets me, and again, it wasn't included in this talk, but like all of this starts, and I mentioned it very briefly, is that this is supposed to address an equity crisis in small business. There is a perceived crisis of investing in small business in 1976. And our dear friend, Ian Lanoff, writes a thing where he's like, so ERISA didn't cause the equity crisis. You know what did cause the equity crisis? The massive recession we just went through, which was kicked off in part by the dissolution of the Bretton Woods Accord and partially by the oil embargo. I feel like that might have caused the equity crisis that we're seeing a little bit. And again, it's really interesting how just straightforwardly this group of financiers are just like, no, it's this one law we hate. It's that one. It's the law we hate. We hate it. And we would like it to go away. So we're going to blame that for the record unemployment that we're seeing, which has accrued over 2 years, and gas prices, which have quadrupled, and et cetera, et cetera. So it's like everything that it's sort of similar to the SBICs. SBICs were sort of this vaguely beleaguered debt-based investment program that the Small Business Administration put together. And they sort of were hamstrung from the beginning because they were debt-based, so they would make loans, they wouldn't make equity investment. And they didn't make equity investment because Congress was like, if the Small Business Administration makes equity investments, that's communism, and we don't like it. So it has to be debt-based. And then when these equity investors roll up, 10 to 20 years later, they're like, equity investment is where the money's at. SBICs don't make any money. We're better than that, and we should all switch over to being equity investors because we make so much more money. And it's like, okay.
And essentially, I don't know about Canada, but essentially every US state operates a version of a venture fund for regional economic investment, which are, it's a whole another research project for somebody else to dive into all of that. So it's 4 o'clock. I want to respect everybody's time, especially yours. So let's officially call a halt to the formal proceedings. Joe, we can invite you to stop the recording at this point. Thank you, Mols, for an amazingly stimulating and generative research project and presentation, and for coming back to Pittsburgh. So more virtual applause for this great things.
I can hang out if people have more questions.
Thank you. I will hang out for a few more. You can tell I get going by this stuff, so I'm going to hang out for a few more minutes. So anybody else who wants to hang, that's great. Joe, thank you for the support, technically speaking. Appreciate everybody coming today. The email, our URL where you registered, we've got more talks coming later in the spring about privacy and security, including a surveillance-based talk later on from a Canadian scholar, which is going to be awesome. So hopefully you'll give some thought to maybe coming back and joining us for a future seminar.